All right, and welcome to today's Monday morning mortgage update. My name is Sean Woolen with the Woolen Mortgage Team here at Waterstone. Thank you guys for joining us today. If you're watching this recorded, thank you for watching this later on our YouTube channel, which is mortgageyoutube.com. And you can always see all the latest and greatest video updates, loan program details, and webinars. It's kind of fun stuff. So fun for me because I'm a mortgage nerd, but we're going to jump right into what's happening today in the markets. So I'm going to go ahead and share my screen, and then we will go in to see what exactly is happening with the markets. Why aren't rates getting better? When will they get better? And then what we can do to move forward to educate our customers so that they can get the best terms and go into contract on homes. So that's the ultimate goal, to find them the perfect home at the perfect price. And let's jump right in. So first off, I want to go over this. This is the 10-year Treasury. The 10-year Treasury, when the 10-year goes up, it says on the far left here, when 10-year goes up, mortgage rates go up. So if you saw the last 4 days on here on this candlestick chart, each one of these little green and red blurbs is one day of trading. So as you can see, we've been trending upwards this last week. We thought we were going to lose a little ground on the 10, but as you can see, rates are rising this last week. So not great, but when you look at the 10-year mortgage rates, when the 10-year goes up, mortgage rates go up. Now, if the 10-year goes down, also the mortgage rates go down. So we want the 10-year to be low. We want it to be really, really low. So the 30-year, the opposite is true. When these go down, mortgage rates go up. When we lose value on mortgages, we have to charge more, so rates go up. So if you look at this last month, guys, there was no fireworks. There was just a fire with a dumpster fire, I guess is the word for it. So it was rough. I mean, we saw a huge decline in the costs of mortgage-backed securities, which led to higher rates. We tried to rebound a couple times, and now the last day of this, we're kind of circling below the 101.4 Fibonacci level, which is not good, which means we'll probably go to the next level. So rates are getting worse today. Not what anyone wanted to hear. If you look at the stochastics at the bottom, those two lines where the black line was above and now it's crossing over below, which is not a good sign either. So the technicals show basically that we could see lower rates. However, we will see what's going to happen this week. I'll go over the calendar to tell you some potential good news that could help us, which we desperately need. So I'm going to go into where rates are right now. We are on a 30-year fixed. Keep in mind, this is a 25% down, 780 credit score, the perfect borrower. Each loan under those same scenarios: primary residence, single family detached home. 30-year fixed, we're at 6.83. 15-year, we're at 6.32. 30-year jumbo, we're right around the 6.9. 7-year ARMs, we are a little bit better on ARMs. So that could be a potential winner, knowing that you have 7 years to time the market to refinance. You could save some money there. And then the 30-year FHA, always in the low, it's about a half to 3/8 better typically than a conventional loan, and same with the VA. So the trend today is worse. Rates are trending higher. Hopefully that will come around. But the biggest fear that the markets have, and the numbers don't really back it, but we'll see this in this week's inflation numbers. But inflation is the enemy of interest rates. The higher inflation leads to higher rates, and that's to protect the purchasing power. So things are worth less when there's high inflation. So you have to charge more, and that's where rates go up when inflation goes up. Also, stronger employment always typically shows higher interest rates. Now, the last employment rate numbers from last week were pretty weak, and we didn't see a huge improvement. We saw some on Friday, which was good, but we didn't retain that. We lost it all today because of oil. So it's back above $80 a barrel again, which is not the best. We can't wait for this thing in Iran to be done with, the Strait of Hormuz to be open permanently forever, and we can move forward with hopefully a normal oil world. But inflation is the absolute critical point that we're looking at this week. We'll go over that in just a second. So what is happening this week? Tomorrow, ADP weekly preliminary estimates. That's coming out. And then existing home sales is going to be coming out. Guys, appreciation of homes nationwide was actually positive for a little bit. And on a normal basis, it was right around 0.3%. So that's good. So we'll see what existing home sales show. Keep in mind, you will see a ton of articles on the median price of homes falling. The median price just means the average price point for homes that are currently selling is lower. That just means there's more homes being sold that are in the lower price range than homes being sold in the higher price range. It does not necessarily mean that the values are dropping. So when you see median home price dropping, it just means that average, the more homes are selling in the lower price range than higher. That's all it means. It doesn't mean that the price of homes is dropping. So just want to make sure you guys understand that piece and get that to your customers as well. We do have an auction tomorrow at 10 a.m. Again, we're raising money. We're creating debt for our country and raising money to spend it on different government projects, etc. Wednesday is the big day. Consumer Price Index, the CPI report. This is the inflation report. This is going to show the Consumer Price Index for food and energy. Now, it's going to be a doozy of a day, I think. It's going to be very volatile, but I do think inflation numbers are lighter than some of the fear mongers out there are expecting. So hopefully we'll get a nice surprise tomorrow. There is also another 10-year or another auction at 10 o'clock for 10-year. We'll see how that goes as well, because if there's a lack of participation, if people don't want it because they think the rates are too low, they want a higher yield on those bonds that they buy, then we could see rates go up. So those auctions are a pretty important piece. And then PPI on Thursday, Producer Price Index. We've got initial jobless claims. We've got a lot going on. So Wednesday is really the big day. We're going to see how that shakes out, and then we'll take it to the next. Well, hopefully rates will improve because nobody likes high rates. Let's just be honest. So let's talk about low rates. Let's talk about the 3-2-1 buy down and how does this have an impact on your customer? Because there's a lot of people that they really love this product and it's really, really good for some people, but I want to tell you where it's going terribly wrong. So it can be a curse for some people, and here's why. When we initially create a 3-2-1 buy down scenario and sell the borrower on, we can get you a lower payment, we can get for the first couple years, and you can refinance anytime in between. Yes, that's all true. But what we've seen is the psychology and the spending habits of borrowers is getting attached to that initial year of a real reduced payment. And not everyone is disciplined. So they're extending their credit, they're buying cars. And then when the rate does go up, it's almost like back in the day when adjustable rate mortgages adjusted higher, they were taken back. They were surprised. They were, wait a minute, this is too much now. This is too expensive. I want to try to refinance. And rates haven't really come down to a point where it makes sense to refinance. So a lot of spending habits are being created because of this really low cash flow on the 3-2-1 buy down. So it is incredibly important to really consult with our customers upfront to make sure that they understand exactly what they're getting themselves into, and they know their payment's going to be quite a bit higher in 3 years and 4 years down the road. And they need to be very disciplined with their spending habits, because I've seen a handful of people come to me saying, hey, I want to refinance, my payment's too high, and they're still in a 3-2-1 buy down. They're in like the third year of it, where it's still at 5.5 or 5.25, and it's still not too expensive because they overextended themselves with the low payments up front. So that can be a challenge. Now, that's also an extreme blessing. So if you're in a job but that you know you're going to be making more in the future, and you just want to get into the house now, this is a great tool. It can be very, very useful for a lot of different people. But if you're on a fixed income type strategy and you're using it because, yes, you qualify for the higher, but your lifestyle doesn't work for fully indexed rate right now or the full interest rate. The only way your lifestyle will work is with the 3-2-1 buy down. That's where things can get really dicey. So be careful on that. Now, moving on to the next, hold on one second. How come this is not working? There we go. Working on to the next, the appraisal changes that are coming our way are going to have a significant burden on every aspect of the industry. Now, I say burden, it's because it's new and we have to adapt to it. And there's a lot of appraisers that are not ready. They have to go through the proper channels to get educated on it, to get certified, to get their whatever licensing and updates they need to do for their world. They need to get that done, and a lot of appraisers are behind the 8 ball. So we're seeing a delay in the numbers of appraisers that need to get dialed into this, and this could affect all of us. So I'm going to have a class. It's going to be a webinar. I'm going to get an appraiser on and talk about this. That's going to be coming up in September. Their schedule they haven't hard coded their calendar in with me yet to figure out what day we're going to be doing this, but expect an announcement for me to go over these appraisal changes. It's basically one form now for everything, but it does affect us in a very large way. So we're going to go over that in detail. And then also, you may have already heard about the major condo approval changes. Every condo that we go through and do financing for on conventional loans has to go through an approval process. We have to analyze their reserves, their insurance. And guys, insurance has been a big problem. Now we have the reserves that a condo is required to take at 15% of the overall budget instead of 10 where it used to be. So that's going to cause potential increases in HOAs. There's a lot going on here, guys. So that's another webinar I'll be doing to go over that in class. So I'm going to be doing that later this month. So just check your emails and your text messages for that, because that's going to be important to see and to be a part of. Now, also, people may wonder why fees always go up and why costs of doing business goes up. Well, fraud is a major piece of that. And fraud, I've seen many. In fact, this last week, I saw quite a bit of fraud and people coming to me asking to do fraud, and I will not do it. So if you're listening to this and you think, hey, I want to do business with Sean because I need somebody that can do fraud, well, that's not me. I'm not your guy. So just keep that in mind. Occupancy fraud is the biggest fraud. Occupancy is where somebody comes to me and says, hey, Sean, I'm buying a new primary home and we're going to work remote and we're moving to Tennessee, but then you turn that into a rental immediately. That's occupancy fraud. Well, you get better rates on that mortgage. It's easier to qualify. There's a lot of reasons why people do that. Cheaper payments. I mean, there's a lot of people that really want the lower payments, so they're doing a lot of shady things to get there. 1 in 44 investment properties has fraud on their applications. 1 in 27 multifamily properties have fraud in the applications, and occupancy is one of the biggest. So there's a lot on investment property side. There's a lot of fraud. So it's up 9.1% this quarter. That's a big chunk. That's nothing to shake a stick at. I mean, that's not a good thing. But I am here to help you, to protect our borrowers, to make sure everyone's educated, because if there's fraud being committed, that loan will be payable, repayable, and due immediately. So you don't want to mess around. That's something that you just do not want to have happen. So I want to also go over one thing with you real quick before we break. I have a texting tool I'm going to be sending out to everyone. That texting tool will allow us to send you alerts just once a week. You're not going to get it for any other reason. So I'm going to be sending you an opt-in for that. And there's a QR code you can scan as well. And then also I do have a podcast room. So I'm going to start booking podcast interviews with real estate community, with the appraisers, with credit repair companies, with everyone that's part of our industry. And we're going to start putting some really good content together for you so that you can learn, you can share with your customers, and we can start making personal podcasts for you as well. So if you want to do a podcast and you want to interview somebody and use our room, you can do that as well. So just wanted to say that that is available. I'm excited to have that, and take advantage of it. I'll be sending out a registration link for that, and it'll be fun. So super excited for that. If anyone has any questions, I'm going to open up the chat real fast. I think there was a couple in there. Bear with me one moment. What is the difference between a red dot and a green dot? Oh, on the candlestick charts, red is bad. Red is bad and bloody. It means the markets are losing value. Green is positive. Green means go. We're in a good thing. So when you're looking at those candlestick charts, if you see a red candle, and this is for all of the candlestick charts that are used for trading for everything, stocks, bonds, everything uses them. Red is a bad day. Green is a good day. Red means we're losing. Green means we're gaining. So when you see those dots, that's what that means. Oh, on the mortgage rate. Got it. Red dot means they're getting worse. Green means it's getting better, I believe. Let me look. Let me go back on that. Hold on one second. Rate. The red dot on the rate. I think that's what I was referencing. The change is in red. I'll have to get back to you on what you were referencing on that. There's a chart you mentioned. Yeah, that might have been the candlestick charts. Yeah, the red and the dot. The dots may be the locking. There's a black dot that shows where we lock. Or if you're talking about the candlestick charts, we can talk about it. Any other questions on this as we move forward? All right, take advantage of our podcast room. It's going to be a lot of fun. It's got 3 chairs in there, 3 hot mics, 3 cameras. We can do a lot of splicing and dicing and make some good videos on that for you. So absolutely take advantage of that. And keep in mind, these classes that are coming up are webinar based, so you can be anywhere. So if you want to, if you're still going to be on vacation or not, or whatever it may be, you can still register and join those as well. So enjoy your week, everybody, and we will be in touch.